Hello, welcome back to the Firetrail Analyst Series. I'm Eliza Clarke, Investment Specialist at Firetrail. Joining me today is Blake Henricks, Deputy MD at Firetrail and Portfolio Manager of the High Conviction Fund. Blake, welcome.
Thanks for having me, Eliza.
Let's talk energy. So, oil, we saw it was a hot commodity through quarter one of 2022. Crude started the year off $76 a barrel, got up to nearly $124 in the quarter. It's settled around $100 now. For now, I should say. Who knows what's going to happen next? But we know with commodities, the two key things that matter are demand and supply. So if we start off on the demand side today, could you take us through what's happening there right now?
Yeah, sure. So, I mean, the oil market is around 100 million barrels a day. And in the depths of COVID, we're hitting down, in the low 80s, high 70s. So it was pretty tough. But what we've seen is a steady return of demand over time. And so even OPEC just recently released the March quarter demand for the world, and you're looking at just off 100 million barrels a day. So we've almost fully recovered. I think what is interesting though in the short term, because economic growth is so strong, they're actually forecasting demand to get up to 102 to 103 million barrels a day by the end of this year, and that'll be driven by a couple of things. The first one is a return of jet fuel, because we're still not flying as much as we used to, especially on those long haul flights. And the second thing is at the moment, demand's being impacted by China lockdowns, and so a return of that as well. So in the short term, I think demand's rebounded a lot faster than people thought, and we're now back at pre-COVID levels.
So that's the update on the short term, but if we're looking at long term, everyone's talking about EVs. I think everyone I know is planning on getting one. How is that going to impact oil demand?
Yeah, sure. Well, the first thing we want to do is look back through history, and what we've seen over time, and you can see it in this chart here, is that demand has grown pretty steadily over the long term. EVs are going to change things, and I'll go into that in a moment. But the second thing is developed markets have really been flat for quite an extended period. Really what's been driving oil growth has been emerging markets as they industrialise and grow from very low levels. And so you can't always extrapolate what you're currently seeing, because the global oil market is a big one and it's really driven by emerging markets. Now, when it comes to EVs are coming in a lot faster than probably even we thought a couple of years ago. I think there's a really interesting case study here, which is Norway. Norway is one of the leaders, if not the leader, in electric vehicle penetration. You can see in this chart just how quickly EVs have grown. You're talking almost 80% EV penetration, and that's of new car sales. So they're up near 80%. But have a look at this chart, and this one talks about Norway oil demand. And what you can see, it's been pretty flat for quite an extended period. And so even with that very strong growth in EVs, you've still seen oil demand being fairly robust. And Norway is broadly a developed market. Now, why is that? Well, there's a couple of reasons. The first one is that oil is used extensively in petrochemicals, things we see and touch, our mobile phones, cars, whatever it is. The second thing is that oil is also used for vans, for deliveries. Now, all these things are going to change over time, but there are a lot of industrial applications outside of just passenger vehicles and that EV threat. So, I think in the long term, we are going to continue to see oil growth. EVs do come, and that causes a drop-off, but we've been saying for quite an extended period now, don't expect to see that until later in the 2020s.
All right, sounds like there's strong demand. Balancing that out, what's going on in supply?
I mean, supply is where it gets really interesting. Any commodity, you just need to look at supply. That's where you should focus, because that's the most important thing. So there's three key areas of supply. The first one is US shale, or what we call tight oil. That industry has been full growth mode, really probably up until 2014, when Saudis put the foot down on their throat. They then came off, they came back, COVID's now hit them again. Where we are today, we think US can grow in tight oil, but there is much more discipline driven by shareholder demands for higher returns. So, we should expect to see more, maybe 1 to 2 million barrels a day for a little while, but we believe that there's not going to be as stronger growth as you would have otherwise expected, even at current prices, because of that shareholder discipline. The second area you need to look at is OPEC. Now, OPEC has been holding production back. They've had these quotas out there. I think what's been interesting over the last 18 months is they've missed the quotas. I think it's something like 14 months consecutively where they just haven't reached what they said they would reach. So what it's telling us is perhaps OPEC is, at or near some of their max capacity. And if you do go through that demand scenario I talked about, which is where we're at 100 today, 103 by the end of the year, they may have very little spare capacity. And then the final one is sort of the catch-all, which is non-OPEC, non-US. And the best way to think about that one is on this chart here, because this chart shows you the capex for the industry. And this is the key chart. I think if you're looking at the oil markets and energy markets, this is the one to look at, because capex is too low. Capex is too low for the demand outlook we're seeing both in the short term and in the medium term. And that's been driven by a range of things: shareholder returns, ESG concerns where people didn't want to invest. We've had COVID where people felt it was the peak cycle oil demand. We're now seeing even higher demand than that. So there's been a whole lot of reasons, but the fact is capex is too low. It typically takes 3 to 7 years to bring a new oil project on. So in our view, that medium term oil dynamic is going to be strong, because even if you lifted capex tomorrow, it's going to take time for those projects to deliver. So the supply outlook looks pretty tight to us.
All right, now playing into that energy thematic, Santos, it's one of our highest conviction positions in the fund today. Could you take us through what matters for them and why it's such a compelling opportunity? Yeah,
sure. And the oil price is always the first thing that matters with any energy stock. But the second thing is really their low cost positions and their disciplined approach to capital. So the first thing is the free cash flow break even of Santos is around $25 a barrel. That may go up a little bit in the next year or two, but they've actually got some really high returning projects. An LNG project in Northern Territory, and at the moment, especially with concerns around Ukraine, Russia, European gas, that LNG project looks to be a very high returning project. They've also got an oil discovery in WA, and they've even got a pretty good returning carbon capture and storage project in South Australia. So they've got these opportunities to allocate capital at very high returns. And we believe when we run those through, the break even drops from mid $20 a barrel down to below $20 a barrel. And that's, that means, especially at over $100 a barrel, there's a lot of free cash flow there for shareholders. Now, one of the challenges I think of Santos, if we go back a year ago, because of all this capex they were spending, the break even was probably close to $60 a barrel. And so it looked like they weren't going to generate much free cash flow. Subsequent to that, they've taken over Oil Search at a very good point in the cycle, and now what they're undertaking is an attempt to sell down some assets. If they are successful in that, we expect very high shareholder returns for the medium term for Santos shareholders, and that's what makes it a really exciting proposition.
Great, thanks for taking us through the energy market update today, Blake, and for what matters for Santos, one of the highest conviction positions in the High Conviction Fund right now. And thank you for joining us for the Firetrail Analyst Series.